Okay, let's tackle this operating cash flow problem. You see the problem in front of you. It says Acme Company is considering the purchase of new equipment that will be used to produce widgets. As the CFO, you've been asked to complete a financial analysis of cash flows associated with this new purchase. And I'm just reading right in front of you here. It's estimated that the cost, that means right now, period 0, where t equals 0, of the equipment will be $285,000 with shipping and installation costs of $25,000. The machinery is expected to last 5 years, and it's expected to sell for $30,000 at the end of the 5-year period. And they let us know that this remaining value is called salvage value. Assume that the salvage value of the equipment will be equal to the market value of the equipment. And what they mean by that is there won't be a gain or loss on the sale of the equipment at the end of year 5. The project's cash inflows will begin during year 1, and we use that as t equals 1. T stands for the time period, and will continue through all 5 years. The company expects to sell 600 widgets each year at a price of $500 per widget. Operating costs, excluding depreciation, are anticipated to be 70% of the sales each year. The firm's tax rate is 35%. And you're asked to calculate the initial cash investment outlay, straight-line depreciation, and operating cash flows for the 5-year period. Okay, now, I've solved that in front of you the way I've solved it, which is different from what they've told you. The equipment cost is $285,000 and the shipping and installation is $25,000. So using Excel, just adding those together, we come up with the initial cash outflow of $310,000. Now the answer they gave you, they said there's a change in working capital of $20,000. And I think what happened is they changed this example and they didn't include any working capital assumptions in here. If we had to invest in working capital, then we would have to add the cost to that. Now you might ask, what would be an example of that? Well, let's assume the equipment required us to keep supplies on hand in case the equipment broke down. Maybe it requires a new motor, or I don't know, you know, new rotors. I mean, we don't really know what the equipment is, and that cost was $20,000. Well, if you needed to invest in those supplies and keep them on hand, then that would require a change in working capital. That's probably a good example for this one. The supplies would be expected to be used up during the first year, therefore they would show up in current assets. And remember, net working capital is current assets less current liabilities. So anything associated with this project that would increase assets, increase net assets, net current assets, or net working capital, which means anything that would increase current assets and also impact current liabilities, you would take that into consideration to determine the change in net working capital. But in this example, they didn't give us any, so I'm going to go with the facts, which say the initial cash investment is $310,000. Okay, then they say calculate the depreciation, and let me slide down. And the depreciation is pretty straightforward. Now they're going to use the $330,000 cost minus $30,000. I see this example as the cost being $310,000. I would not include $20,000 in net working capital for supplies in the cost of the equipment. And there was nothing else in this that led us to believe that the cost was $330,000. So the way I would calculate the straight line depreciation is I'm going to calculate it right here. And what I'm going to do is take the $310,000 given in cell C24, and I'm going to subtract the $30,000, which represented the salvage value that we expect at the end of 5 years, and then divide it by 5, and that's the same depreciation in every year. And on this section right here, perhaps I should bold this so it's clearer for you, I'm going to work on calculating the operating cash flows. Now, one thing I want to point out is if I highlight, or if I were to sum all of the depreciation, you will see that that would equal $280,000. And 280 is indeed 30,000 less than 310. So the book value or salvage value will be 30,000 at the end. Okay, so how do we put the operating cash flows together? Well, we list the sales. They told us 600 units at $500 each. Right? 600 units, $500 each. That's the same in all years, so we can, once you put that formula in, you can just copy it over. The operating cost was 70% up, but I didn't spell excluding correctly, so let me put that C in there. So we take the value in cell C45 times 70%, that's my operating cost. And in this schedule, I'm using negative numbers or numbers in parentheses to represent anything you would subtract. Okay? So sales less operating costs would get you, well, it would help get you down to income before tax. We would also take depreciation expense and have to subtract that because that's part of this operation as well. The way I want to indent that so that it lines up right. Let's see if I can get that to line up right for a second here. There we go. Okay, so we've got sales less operating costs less the depreciation, and that would give us income before taxes. Then they told us the tax rate was 35%. So if I take the income before tax times 35%, of course I'm making it a negative in there so that we can see that's something we would deduct. Then we can come up with income after taxes from this incremental project we're taking on. Now, depreciation is a bookkeeping entry, right? The actual cash flow occurs when we bought the equipment, and then we'll get some of it back when we sell what's left of the equipment after year 5. So we're going to add back the depreciation. Now, in this example, I am assuming that the straight line depreciation that we're using for purposes of this example is also the same depreciation method that we're using for tax purposes. Okay? If this problem was a bit more complex, we would be using tax depreciation here rather than just a straight line depreciation, and we would use the tax depreciation that's required by the IRS. But to keep this example simple, we'll assume that the book depreciation that we're using, straight line, is also being used for tax purposes. Okay, so that'll get us income after taxes, and then we have to add back the depreciation because that's a bookkeeping entry. There's no real cash flow involved. When we subtract it up here and then add it back, what happens is we wind up the difference between the subtraction and the add back, some people call the tax shield from depreciation. You wind up with a tax savings because you pay taxes on expenses. The IRS allows you to deduct it as an expense, but depreciation is not a cash outflow. So I find the easiest way to do it is show it up here, then add it back. Okay? Now, if we had changes in working capital, then we would put it down here. And I believe in the example, they showed that there was this 20,000 change in working capital, but they didn't give that to you in the facts above. So I've left it off. If we did have to keep 20,000 in working capital, it would show up as a negative right here. All right, let's assume we needed supplies of 20,000 at the start of this project, and in theory you would liquidate those supplies by the end, so it would appear like this. It would cost you 20,000 of additional investment to buy those supplies up front, and then you would get it back at the end. Okay, so that's how it works. But in this example, the facts didn't present it, so I'm going to replace those with zeros. And that would give you the net operating cash flows. Now, I want to be technical here. We're still going to get 30,000 at the end of year 5, but that's not that 30,000 you get back is not considered to be an operating cash flow by most folks' definition. Most folks would say, no. That's the gain or loss that you get as a result of liquidating the equipment falls outside of changes in working capital. Now, we don't have a gain or loss, so I guess I could go both ways. I guess I wouldn't have a problem saying maybe we should put that somewhere up here. Maybe we call this changes in working capital and other operating cash flow changes. I wouldn't have a problem putting it up here and say, no, really, that 108,000 was part of this because we anticipated it. We anticipated selling the equipment, and that's part of the operation. But I think some textbooks will say, no, the sale or the liquidation of equipment at the end of the project is external to the project itself, and therefore we need to treat that as outside of operating cash. Okay, so I'm going to treat it that way only because I've seen how textbooks have handled it that way and come up with two totals. One is the net operating cash flow, and then one is the net cash flow. Okay, now I've jumped over to the web page where I've put together some multimedia presentations for you. Okay, and in this one, if I slide down, I want to point out that there's another example I've put together that I think would be helpful for you. And that's this one right here. Well, all of these should be helpful, but this one that deals with a new product introduction, if I click here, I think gives you a real nice example. Okay, a real nice example of how to put together a cash flow, and then for a more sophisticated product, not an extremely sophisticated, but here I go through an example of capital budgeting for a new product, and I think I take it about 10 years out, and I show you how you solve NPV, how you solve for net present value, internal rate of return, and payback. So that's available to you as well. And to find that, just go to the multimedia presentations that I've put together, right? And for anybody watching this that's not in the class, you can visit penn-oaks.info, www.penn-oaks.info, and then search for that page under Managerial Finance. And if you slide on down, you can take advantage of that one I just pointed out, which is the new product introduction. And by all means, anyone on the web is welcome to look at anything I've put together. Okay? I hope you found that helpful. Let me put that back to where we were, and I'll talk to you later. Thank you.